this time we are laying down the details of the mechanism to be launched if a Greek request is presented to the Eurogroup, the Commission and the Central Bank. This is a step of clarification the markets are waiting for.
This is quite good as far as it goes. It staves off the immediate refinancing crisis, the liquidity problem Greece has been having in the markets, but the onus is still on Greece to adjust. This amount of money is, at this interest rate is not going to solve the problem. It's just going to push off the day of reckoning, and Greece now needs to avoid or prevent a day of reckoning by making a strong enough fiscal adjustment to avoid another refinancing crisis down the line. Okay. And the jury's going to be out on that for a while.
The package does alleviate the concerns in the short term. However, it does not provide a lasting solution. Initially, markets will definitely beef up prices of Greek assets because the question of immediate bankruptcy is almost off the table, although remember that the IMF still has to approve the conditions of the loan and the Greek may not like them. But in the longer run, the 45 billion euros amount only to what Greece is still yet to borrow this year to roll over debt and to finance its budget deficit, only for this year. But for the following years, they may still have the same problem. So I think that to a large degree, the solution only prolongs the solution. It just pushes the problems further away, and markets can focus on other weak members of the EU. So yeah, temporary respite for the markets, but not a long-term solution.
Both the size of the package and also the terms of the package are probably better than the market was looking for when it closed on Friday. So a reasonable rally in the euro makes sense and may continue a little bit in the near term. Beyond that, though, we wouldn't be looking for too big a start of a trend, given that some of the structural problems exposed by the whole Greece episode still very much remain in place. Question marks about monetary union in the absence of political union and fiscal union, issues that aren't going to be going away anytime soon.
Well, there's not much point prolonging the uncertainty. Spreads, as you said, are down this morning, but Greece is unlikely to get better terms than those that are on offer now. And tomorrow's T-bill auction will not be a conclusive test of market access because of the short maturity and small amount on offer.
The 3-year loan would be about 215 basis points below the current market rate. But it's still above what Greece was paying, in the beginning of the year. On the other hand, the 10-year loan, if Greece uses it right now, would be 15 basis points more expensive than the market rate. So it's not so clear-cut. It seems that Greece will use the 3-year tenors because it's the most advantageous for them. And as a result, I think that there may be some continued steep declines at the short end of the Greek government curve. But it shouldn't fall below the levels that the EU is offering. And basically it tells us that speculators maybe were too pessimistic at the end of last week, but in the medium term they were right to trade Greek debt at a steep discount.
The positive here is they've been held within the euro. The horror stories had them leaving the euro, which I think would have been very, very bad. So I'm delighted by what's happened. But now Greece has to fix its balance between revenues and spending.
The adjustment Greece is going to have to make is going to be one of the biggest in history, right? Our assessment is that, assuming that interest costs don't continue to rise, just to stabilize the debt at twice the legal limit is going to require about 10% of GDP in primary fiscal adjustment before interest payments. It's an enormous adjustment for any country, let alone for Greece. And then, of course, the interest bill has gone up and the economy is going to shrink as a result of the adjustment.
To reverse the explosive path of the debt, Greece needs to generate a primary surplus of 6% of GDP so that it can cover the interest costs without resorting to further borrowing. That's a swing of 9 percentage points of GDP compared to this year's 3% deficit, which is huge, but it's possible, certainly doable, and not unprecedented. The rescue package that was just agreed by the Eurogroup addresses the short-term liquidity issue or crisis. But there is still a solvency problem out there that needs to be addressed by significant further fiscal tightening and by the structural reforms.
Confidence is the name of the game here. It can deliver in terms of austerity, but it also has to deliver in terms of these reforms. They will take time, and these reforms also need a mentality change in Greek society.